out by David Kostin of Goldman Sachs today, saying the S&P will serve up just 3% annual returns over the next decade. That's far short of the booming gains of 13% from the last decade. And it comes as the S&P and Dow do hover near record highs, coming off the longest winning streak of the year. Let's talk more about where this rally goes from here this morning with Fundstrat Global Advisors Head of Research and CNBC contributor Tom Lee, who recently raised his target to S&P 6K. Tom, good to have you. I loved your note the other day looking at what S&P revenue has done in the face of declining inflation. And your general point is that real revenue has accelerated, and that kind of explains why equities have been so resilient.
That's right, Carl. As you know, many investors and pundits thought as inflation fell, and it's been cut in half in the last 2 years, that would cause revenue growth not only to hit a wall, but that earnings would stall. But instead, S&P revenue growth is going to be over 5% this quarter. And on a real basis, that's over plus 2%. And that's the strongest. It's really one of the strongest numbers in more than 2 years. And so it is a really high quality earnings season so far. And, close to 80%, or actually more than 80% are beating earnings so far. So it's a good beat season, but it's early.
Right. And how much of it is due to financials? Is any kind of tailwind, although we heard various comments about this, if a Fed tailwind does exist, is it likely to affect other areas of the economy as much as the banks?
Well, in your opening comments, you talked about industrials, and that's something to watch because last week financials reported, and it was, pretty much universally better than expected, and financials are doing really well year to date. But the other group that's very sensitive to the Fed cutting would be industrials, and there's a lot of industrial reports this week. It's about a quarter of the S&P, but I'd say it's so far so good. And again, industrials are doing well in the face of an ISM that's kind of been at rock bottom for 2 years now.
Tom, how much would you ascribe the recent momentum to aspects of the election as that draws near, just over 2 weeks away?
I think that's been a dynamic. I mean, I've been fooled by seasonality because I figured from September to Election Day, markets would be very tentative because this is an extremely close race. I mean, this is a coin toss, according to Nate Silver. But something that Stan Druckenmiller said last week might explain a lot, that markets are betting that Republicans could take the Senate, and that actually could ignite animal spirits. So there may be underlying momentum that the Republicans take parts of Congress, and that's why markets are bullish.
Are you at all worried? There were some comments out of German PPI was down 1.4 year on year, Tom, but there was some ancillary commentary about worries about a reflationary period, largely due to geopolitical events. We mentioned oil coming back a bit today. How worried are you about that?
Well, I think that headline CPI could definitely get affected because oil moves dynamically, and it has an almost immediate effect on headline CPI. And we know transport costs have also spiked recently. Part of it's seasonal, but that affects headline. I think the market's going to be somewhat skeptical that could trigger a sustained reigniting of inflation, but I think the economic data is going to be a little confusing the next couple of months because, the Boeing strike itself is going to affect the jobs report. But I think ultimately the Fed is still on a path towards getting back to neutral. I think that should be the focus, and that means, stocks which have been strong are really still a buy the dip market.
I'm curious, Tom, in the intro to this segment, Carl outlined what Goldman is saying this morning with regard to kind of longer term returns for equities and the competition they may face from other asset classes if, as Goldman says, the S&P 500 delivers an annualized nominal total return of 3% during the next 10 years. It could face competition, obviously, from potentially treasury yields, which are at 4%. How are you kind of thinking about just the overall asset allocation in light of some of these potential changes in just the overall dynamics of the market?
Well, I haven't seen the Goldman report, and I'm sure it's thoroughly explained. But to me, a 3% nominal return for the S&P, which is basically inflation, tells me that the PE multiple in their model must be contracting because S&P earnings should be inflation plus GDP growth. Let's say that's 6 plus buybacks, which would be 8, and then if there's any multiple expansion, you should add to it. So I think that they're talking about a derating of the stock market. I'm a little skeptical of that because last week I was at a very large advisors conference and I polled the audience. It was close to 400 people in the audience, and I asked, how many of your clients are over allocated to stocks? And I saw one hand. And then how many feel under allocated to equities? Because as you know, a lot of stats show that there's no cash on the sidelines or whatever. I would say close to 80% of the audience raise their hand saying that their clients have been avoiding stocks for the last 2 years and feel under allocated. So to me, that points to stocks having better than expected returns over the next decade because they have to allocate. But, Goldman's, it's 10-year view, so they could be right.
Right. But it also fits with your view from a few weeks ago about margin debt, does it not?
Yes, that's right. Yeah, in fact, the audience response is very congruent to what we're seeing, which is there's been a de-risking just in the last 4 months in the face of a market that's been relentlessly rising. I think there's been a lot of macro skepticism, and it's triggered a lot of fears. I mean, partially, I've been fooled by that because I thought markets would stall, but they've been very strong. And to me, the market is the signal.
Tom, great discussion. Way to start out the week. Look forward to talking again soon. Tom,
Thank
this
you.
morning, Fundstrat.
There's been